Another week of all-time highs, guys. I feel like I say the same thing every single week, but it is what it is until it isn't. My name is Hamilton. I'm here at the Trading Initiative, and in this week's Markets in Focus, wrapping up February 9th, 2024, we're going to look at the good, the bad, the ugly, and what we can reasonably expect over the next 2 to 4 weeks. We're going to go ahead and start with this intermarket analysis, which is a great bird's eye view of the more important areas of the market, how they performed over the last week. We have to start the conversation off with Bitcoin up 10% this week. If you've been trading crypto for an extended period of time, I mean more than a couple of years, you've been through these cycles before, the latest oscillation to the upside and downside should not have shaken you out of any sort of long position. We are of the understanding that we're at the beginnings of a new primary uptrend, which will probably see Bitcoin at all-time highs sooner rather than later. I have zero time frame on this, but I'm expecting new all-time highs before some of the doomsday preppers predictions come true of like 10K and stuff like that. I just don't see it. Basic technical analysis says quarter over quarter highs, trading above the 200-day moving average. This thing has all of the juice to hit some all-time highs. So if you're trading BTC, feel free to continue to let that position sit on your books for as long as Bitcoin's trading above the 200-day moving average at minimum. But also if you're trading some of the equities related plays, your Maras, your Riots, your Hives, your coins, you're going to see positive pops in those names across the board with Bitcoin surging as well. We did open up new positions 2-ish weeks ago. We should be able to flip those things free as of when the market opens up today. Currently, the market's not open. We're going to be able to flip those free. So it's a great opportunity for us to grab more exposure to the upside in BTC's value, but through a leveraged product like Mara and Riot, etc., specifically if you're trading options. So good job, TTI members. And for those of you that had that whereabouts to buy that stuff 2 weeks ago at pullbacks at logical levels, you're going to profit as of, at the very minimum, market opens up today. We'll see where we're at. Oil, though, oil up 5.68%, finally catching a bid. Feels like oil's been depressed for the last 3 to 6 months. Does this kick the inflationary data back up? We're going to know over the next 2 to 4 weeks whether or not this rising price in oil is going to negatively impact inflation. Theory states, yes, we will see inflation tick back up if oil starts to tick back up. Goes hand in hand. We'll see what the Fed says about that. Growth up 3.61%, the 10-year yield up 2.85%, 30-year yield up 2.81%. Bonds just not catching a bid. Once again, we had some pretty bad auction data come out this week. The Q's up 2.59. Emerging markets are up 1.68, which is awesome because China sucks, which we're going to talk about in a second. Commodities are up. Everything, for the most part, is up that matters except bonds. Unfortunately, we would have liked bonds to be up, but they're not. And we're going to talk about the ramifications behind that shortly. Let's go ahead and have a quick peek at U.S. sectors and U.S. industry groups over the last 3 months so we know, hey, are we in the right spot when we're long? Are we shorting the right parts of the market if we're short? As of right now, over the last 3 months, going back to November of 2023, tech is in control. Should not be a surprise. It was the leading sector last year. It's probably going to end up being the leading sector this year as well. If you're long tech and you can hold through the oscillations, or if you're opening up new positions at logical levels, you're going to be making a couple bucks. We're expecting it the very minimum through Q2 before some sort of major pullback in May might occur. We still think there's going to be a potential pullback in February. We're only, 9 days into February. We're not going to talk about that yet, but we do think so we're prepping for it. But as of right now, tech, comms, financial, and industrials are leading the market over the last 3 months. If you're not long those areas, you're missing out on a couple bucks right now. Healthcare silently, no one's really talking about healthcare, but silently creeping up as well. Healthcare actually hit all-time highs this week, the sector itself. Let's go to the industry group, semiconductors. I mean, that's the big story. It was the big story in 2022 with how much they sold off. They were the leading sector in 2023, and they're the leading sector in 2024. Guys, these industry and sector groups move and oscillate between a small portion of big winners, and they tend to go for years in some instances. And in this case, we're on year 2 of tech and specifically semiconductors outperforming. If you're not long these parts of the market, or at the very minimum looking to get long at logical levels, you're going to miss out on huge amounts of profits, just like you did in 2023. So I'm not saying go and YOLO buy NVIDIA right now, but during market pullbacks, or if the individual asset's pulling back and you can reasonably risk on, risk off at some level, you should probably be trying to grab a piece of this because this is part of the market that is going ape shit right now. No pun intended. It's going nuts. We're going to look at one in particular that we were in and able to catch it. But home builders up 26.83%. Jet silently creeping up. That's going to be a big determining factor in industrials hitting new highs, right? So airlines are finally starting to show a little bit. A lot of the charts are a little wishy-washy, but we're liking the strength there at the very minimum. Internet up 24.65, software up 22.79. Really just a nice group of stocks up there. And most of these things, other than the home builders, are going to be relatively easy to trade on the options chain. Home builders, you're going to have to go and hunt a little bit for some volume and liquidity. But you can still buy them. These are solid uptrends. Going back to the 3-month on factor analysis, it shouldn't be a surprise that large cap growth is going to be screaming back into the leadership role over the last 3 months. So if you look at this outperformance from the middle of November through the end of December, if you go back and listen to our content, we were really big on smalls and mids, potentially continuing to outperform the market in 2024, but the market had other goals. So we had to flip the script. Our thesis coming into the year was invalidated rather quickly as we saw large cap growth start to catch a bid at the beginning of the year, and the rest of the market actually start to regress. Now, once again, that doesn't necessarily mean that everything sucked. It just means against the benchmark, it wasn't outperforming like large cap growth. So that's why we started allocating our resources, our scarce capital, back towards large cap growth. But we're starting to see a potential bounce, right? We see small cap growth start to catch a potential bounce here, but realistically, it's large cap growth. Large cap growth is large and in charge. And if you're not long this particular part of the market, you're probably not making a lot of money to the long side. Right now, the scope should be on the big boys. People want to complain about market breadth. I totally get it, but the indexes are hitting all-time highs almost every day, and they're being led by the most important companies in the world. If you're not trading those most important companies in the world, you're missing out. So try to take your ego out of it. Try to find those companies at logical levels and trade them. Don't just sit there and complain that the market is doing something that you don't like. That is bitch shit. You don't want to do that type of stuff. Let's transition really quick to Twitter. There's 2 posts in particular that I want to talk to. First one here by Stephen Goldstein. He's Alpha Mind 101, a trading psychologist. Just put a really awesome picture there talking about profitability, drawdown, stuff like that. Now, inside of the trader development program, specifically with the newer traders, most traders in TTI make a couple bucks relatively quickly, but then they draw down. It's part of the system. You're going to make a bunch of money, and then you're going to draw down, then you're going to make a bunch of money, and then you're going to draw down. And over time, as long as that slope of the equity curve is up and to the right, you're doing something right. That's a very simplified way of putting it. But realistically, if you look at this picture that he has here, he says, every time that your equity curve goes up and over the trend line, it's essentially excessive profits borrowed from the market to be returned in the future. And every time you draw down and you're below the trend line, you can think of it as money you lent to the market that will be returned to you in the future. So instead of internalizing all of these drawdowns and saying, man, I'm screwing up, I'm not doing anything, understand that this is what a real profitable trading curve looks like, equity trading curve. If you see something going parabolic over an extended period of time, they are selling you lie. All right, guys, it's up and to the right over time, oscillations of higher highs and higher lows over time. Every time you start to draw down, understand what you need to do, which is position size down, maybe less positions overall in the market, ride through the storm, and then get to the other side when the market starts to have more accommodative environment for you to be trading in, and you'll see once again profits shoot up. So this is a great way to kind of internalize that during drawdowns, understand how to deal with that, but know that that's part of the process. If you internalize that stuff, you tend to start self-sabotaging yourself, which is what I try to work with guys extensively to not do that, and try to, at least at the very beginning, convey that this is a normal part of trading. And generally it's about, sometimes it takes up to 6 months for people to stop kicking the shit out of themselves when they lose, because they start realizing when they pull the time frame out on their equity curve, they start realizing wow, you're right. Over time, I'm making a good amount of money. So this is working, right? So last part, or not last part, but the second post here on Twitter that I want to talk about is from Next Big Trade. This particular post is just a screenshot of a book page. Obviously, you can go ahead and pause this and read it if you want. But what this talks about is that the stock itself is not the most important part of the trade. Generally, it's not. So we utilize something called a top-down approach in TTI. The top-down approach builds the macro idea first and then plugs the stock in that we think will best represent that macro thesis that we have. In this case, it's sector, industry, and market cap strength. So we want to be long that particular part of the market first, and then finding whichever stock fits our thesis the best based off of technical analysis and a bunch of other things. But what's more important is that we're trading the right area of the market. And in this particular page of the book, it's called, or the chapter is What to Buy, My Forest to Trees Approach. He talks about that the overall market cycle, sector cycle, and individual stock setup, all of that stuff, when those three line up is when you get the big win, which you're going to see in a second. We traded ARM. We've been in ARM since November, and we caught the 50 or 60% move yesterday, and we made a lot of money, right? And we have positions to go out to July. This could be a 5,000% winner potentially. And I'm not just saying that to over exaggerate, but it comes down to, are you in the right part of the market first, and can you plug the stock in afterwards? It's a very important part of trading. The bottom-up approach is more focused directly on the stock and the setup itself and trading your little chart patterns and stuff like that. We prefer to go with, where are the financial institutions really pushing the market? Once we can figure that out, We want to find which individual stock is going to give us the best opportunity to make some money. That's how we do it. That's great. Let's move into TradingView and talk through a few key things here. First things first, SPY all-time highs as of pre-market this morning. We are knocking on the door of $500. Congratulations. Get some new hats printed. SPX 50,000. Looks like we just got it. 50,000, excuse me. Let's look at SPX. It's not 50,000. It's 5,000. This is not the Dow. We're knocking on the door of 5,000 SPX. So get your new hats ready. We're probably going to get it today, which is awesome. But once again, for the guys that are screaming about breath sucking, I get it, but the indexes don't care. As a matter of fact, you're doing yourself a disservice by complaining about breadth. You can plan for breadth breaking down and what that typically means to the market over an extended period of time that we're probably going to get some sort of pullback. I get it. We're prepping for that as well. But if you're consistently bitching about the fact that the indexes are hitting new highs and you're missing out on it, you are just a loser. And that's okay. You just have to understand that you're a loser and you need to fix it. All right. So instead of bitching about something that doesn't make sense, go fix it. The Qs are also at an all-time high here, pre-market. IWM, the odd one out, still underneath the $200 area. We are patiently waiting for small caps to break above the 198.5/200 level and stick it. We're still not there. So we're not fully vested within the small cap space. As a matter of fact, the only areas within the small cap space that we have any positions in whatsoever are semiconductors and software. Why? Because those were the two leading industry groups of 2023 within the tech space, and they tend to be the same industry groups that are leading in 2024. So that's the only place that we have a little bit of exposure in right now in the small caps. But for the most part, we are long large caps. Why? Because large caps are what's working right now, and we don't need to reinvent the wheel. Talking about bad breath, yeah, I understand there's narrow leadership at the top, but here we have RSP, or equal weighted S&P 500, clearing a 2-year high. So of all 500 stocks in the S&P 500, equal weighted, meaning Apple is going to be the same weight as the 500th company, we are now breaking out into 2-year highs. Breath sucks. I get it. Narrow leadership at the top. I get it. But they're also the most important companies in the world for a reason, because they're the best companies in the world. And here you have an example of breadth actually showing that, hey, it's not just necessarily the leadership at the top that's skewing everything. As a matter of fact, the average stock in the S&P 500 is pushing up, which is why we see new 2-year highs in RSP. And also look at the equal weighted Qs and see, knock, knock, we are knocking on all-time highs with the QQEW. As a matter of fact, I think we closed there earlier this week. Once again, I understand people want to make the case that it's just NVIDIA right now and it's just some of the large cap tech stuff that's really pulling everything up. But when we look at the equal weighted Qs hitting all-time highs, come on, guys, use your brain. It's not just 3 stocks pushing the market up. It's a lot of stocks. Let's look at the dollar. This is arguably the most important chart in the entire market. Now, we have been cautious above the 104, particularly above the 200-day moving average in the dollar. You know that this is inversely correlated. So every time the dollar starts to catch a bid, stocks are at the very minimum facing a headwind of going up anymore. And every time the dollar starts to drop, we see stocks really rally here. So if we're above the 200-day moving average and particularly above that 104 area, we do think that there's an opportunity for the Dixie to come up and retest 107 before coming down. No idea if it's going to happen, but it's in the back of our minds. So we have to have some sort of scenario prepped for if the dollar does start to break out again. And once again, it is above the 200-day moving average. So it's in the back of our minds. This is the most important chart in the world for us. If the dollar does break back down below the 200-day moving average, we expect the market to absolutely fly, because that's how it's been for the last 2 years. Inversely correlated assets. The dollar is in control as of right now. It is stalling out up and over the 200-day moving average over the last few sessions. This is more of a consolidation than anything else. Whether we resume to the upside or not will remain to be seen. Bonds, also very important, and not catching a bid this week. As you can see, we started to, and then we're right back down below the 200-day moving average. The 92 area in the TLT chart is incredibly important for us because we have positively identified, and it doesn't take, a charter market technician to realize that bonds and stocks right now are positively correlated, generally speaking. As a matter of fact, they've been correlated for the last year and a half, something like that. About a year, I think, actually. But for whatever reason, at the end of December, they've started to decouple. As a matter of fact, bonds are starting to enter some sort of short-term downtrend. And we just showed that the indexes are still hitting higher highs. And so we have to ask ourselves, is the intermarket relationship that we've noticed over the last year, a positive correlation between bonds and stocks, is that broken? Or are bonds telling us something that the equity market is eventually going to price in? And that's get the fuck out. We don't know yet. We have no idea. But we do know if bonds break down below 92, just like Dixie above the 200 and 104, we're going to be very, very cautious. We would prefer bonds to catch a bid and bounce. We thought they were above the 200-day moving average, and we were really excited, but here we are once again retesting previous support. We'll see what happens. We have no position on this, but we're definitely watching it. Is it time to buy Chinese stocks? Come on, guys. It doesn't take a rocket scientist to look at something and go, well, it's below the 200-day moving average. It's below significant overhead resistance. It's below a volume shelf. Come on. There's a lot of things you could be buying right now, like the U.S. domestic market that is hitting all-time highs every single other day, whereas the Chinese stock market is trading at levels that it saw back in 2022. Absolutely zero movement. There's no reason to be locking up your precious capital and stuff like this unless you're one of those guys that really likes to buy things for 10 years straight without seeing any cash return. Maybe BABA will eventually be back up in $200, $300. Potentially, it could. But if you were buying this thing back in 2021 because you thought it was cheap when it was already 50% down, we go peak to trough here, 50% down, you go, man, BABA is really undervalued at $157. Well, you should absolutely love it at 71. It's down another 55%. You know what I mean? Buying this type of stuff doesn't make sense from a technical standpoint. And if you're still long this stuff and you bought it because you thought that there was some sort of technical advantage here, well, you're not executing your technical system right. From a fundamental standpoint, you could think BABA is undervalued, totally fine. But at what point are you mad that this thing is not moving? At what point do you realize the opportunity cost of owning Chinese stocks is absolutely robbing you from the opportunity of making a shit ton of money in the U.S. domestic stock market? Just food for thought there. Tech sector breaking out into all-time highs this morning. Why? Because software and semiconductors are going absolutely bananas. So let's go ahead and look at tech semis, all-time highs. We just saw one of the biggest, one of the biggest earnings reports come out from ARM. We're going to look at that in 1 second. That's the name that we're long. We've been long since November. Just ran a webinar on that actually like 2 days ago. So feel free to go watch that. Over 1,000% winner, and we still have 4 or 5 months worth of expiration on those. So this could absolutely be a multi-1,000% winner for us if the market wants to continue to reward ARM. But we see semiconductors at all-time highs again. People want to talk about a bubble. Is this a bubble? Probably. Yeah, probably. Does that mean you can't make money on the front side of a bubble? Absolutely not. If you're the asshole waiting for the top to short the backside, just understand Stanley Druckenmiller did the same thing and lost $1 billion on the front side. You know, and then he bought the actual top, and then the market started to break back down. These things can go for an extended period of time. Bubbles can form for years. So if you're sitting here waiting, I don't want to participate in a bubble, that's fine, but you're probably going to lose a couple bucks trying to time the top, and whether or not you actually get in on the backside by then because you're going to be bored because the market's going to go up for who knows how long, it's just going to suck. We'd still expect a pullback, don't get me wrong, but to think the bubble's going to burst, I don't know about that. Software is knocking on all-time highs here. Go ahead and remove that from a previous video. Software all-time highs somewhere near 450, 445, something like that. Currently trading 440. Once again, if you're not long these parts of the market, you're I don't know what you're doing. I really don't know what you're doing. Let's look at a couple stocks here that we have been long before. ARM, we bought it back here in the November breakout. We've added in during the consolidation. We caught the big earnings move yesterday. ARM, semiconductor stock, whether or not you love it or you hate it, this was a fantastic trade. It made a lot of money for us, and we're continuing to stay long ARM because we have free positions on the books. Why would we not? We have expiration all the way out to July. People are going to ask me, is it time to buy ARM? No, I think the time to buy ARM was pretty much at any point prior to ER. This does set up something called a COD setup, which means that if we do start breaking back up and over where we closed, yesterday, we're going to be able to potentially reopen the position, but the IV is so juiced on these right now that I don't even know if it's worth owning contracts on this. Unless you're selling premium to get long, this thing is going to be a pretty tough trade in the short term because, I mean, everybody that's in it is already in it. Also, there's a lockup period ending in March, just to throw that out there. So watch out for some selling pressure coming in March. You see NET. This was a trade idea that we had on the books. You can see we wanted to buy it today on a pullback through ER, and instead of pulling back, it gapped up. So unfortunately, we were not able to get long NET. But this is a huge name in the tech space, particularly in cybersecurity. So your PanWs, your CrowdStrikes. This bodes very well for all of that. Speaking of CrowdStrike, here's a trade that we're in. We bought the all-time high. Guys, by the way, we have no problem buying high and selling higher. Whoever tells you that that's a losing strategy does not like to win in uptrends. Bull markets are arguably the easiest time to make money. All you have to do is buy stuff that's moving up and then sell it higher, right? That's what people like to say. Well, that's what we did in 2023. We're still doing it in 2024, and it's making sense. CrowdStrike gapping up. It's gapping up on Net's earnings reports. We're going to see PanW. I haven't even looked at PanW this morning. PanW reports shortly, and they're probably also up. There you go. They're up into all-time highs as well. This is another name that we've been trading. So PanW, CrowdStrike, we missed Net, but this entire industry group in particular, the cybersecurity names are going to push that software sector itself up into new all-time highs. But this has been one of the best areas to trade. For the last year and a half, just absolute fantastic moves. If you haven't already grabbed this stuff, I don't know if there's a way to get long now. Look for a pullback in Net potentially. I don't know. Let's talk about this pullback. So we are short a couple names. We were short. We'll start with the one that we've already closed, JKS. So we were short this name. You can see the actual short setup. The way that we trade shorts inside of TTI is we don't like to hold for the bigger move. We like to buy 45 days out maximum. We like to sell on something called the puke candle. The puke candle is generally something like a 2 to 3x ADR move. And we had that puke candle just the second day after we opened up JKS on some bad Chinese data that came out. The Chinese market absolutely got obliterated, JKS being a Chinese solar name. So we were able to close those for anywhere between 130 and 81-ish%. The puts just absolutely blew up for us. So we were able to get out of that. Other names that we are long, we just opened up Chewy yesterday for the first time. Now, this is more just a play. If the market pulls back, Chewy is basing into all-time lows. We expect just a puke candle at all-time lows and then potentially a bounce back up. This is going to be a very quick short trade if it does end up playing out. There's not a lot of money behind these shorts. We are firmly in the camp that this market is going to go up over time. We do not want to miss the pivot. So these little shorts are tactical and aggressive plays to the downside. If they don't work, it's not going to break the bank. If they do work, we're going to be able to just add a couple bucks to our account in order to buy better names when the market does start to bounce, if it ever pulls back. I don't know. What I will say is every single short that we've taken so far, other than I guess this Chewy one, because this is day number 2, is either break even or in profit. So at least we know we're short the weakest stocks in the market. Winner, if the market does pull back, those should play out. But right now we're hitting new highs almost every day in the indexes. So I can't sit here and scream to you that the market has to pull back. The market's going to do whatever it wants to do. But we are positioned for a slight pullback in the middle of February. We'll see if that plays out. Chewy is going to be one of those trades. We took March 15th dollar puts for like 50 cents. We'll see where they're at in about a week or two. LPG is another one that we're in right now. Just a very basic technical breakdown below 36.5. This was break even for a majority of the trade. I think we're going to open up slight down. We're just targeting the move down towards $32. It's not really that big of a deal here. If it doesn't play out, once again, not going to break the bank. But if it does, we're going to be able to make a couple bucks. And then MOS, this is an agricultural chemical name. It's the same idea as Chewy. We're looking for a big breakdown across the support level. This is up for us about, I think, 25 to 30%. We'll see what happens over the next 2 weeks here. The goal, once again, at least inside of TTI, is not to make $1 billion on the short side. It's to not miss, if we do pull back, the pivot. I have no idea if we're going to pull back. History shows that February is a very weak month, generally speaking, especially during an election year, which we're in. But as of right now, 9 days into the February, we're opening up at all-time highs, and we can't sit here and say the market has to do this because it did this in the past. We have to play the price action as it's presented to us, which is why we didn't close all of our longs, even though we had a bearish outlook in the short term at the beginning of February. Take that and ingrain it in your brain. If you are short or short-term bearish, that does not mean you have to close everything on your books to the long side. As a matter of fact, the only thing that matters is price. And if you're hitting higher highs and higher lows over time, you should not be looking to time the top, or, we wouldn't have been able to catch things like ARM. We wouldn't have been able to catch things like the Mara play that is going to be up, 200% at open, things like that. Don't try to outsmart the market, play the price action. Guys, my name is Hamilton. I'm here at the Trading Initiative. If you like this type of content, please like and subscribe, leave a comment below. If you'd like to leverage our services and get 1 to 2 daily emails per day, trade ideas 5 to 10 per week, etc., you can sign up for our market research portal. Link is in the description below. It's a lot of fun. We have a bunch of new members that have come in over the last few weeks to help beta test this, and it's currently live. It's a lot of fun. You're going to have 3 to 5 weekly events per week that you can show up and watch me rant on camera about charts, etc. You get trade ideas, 1 to 2 newsletters per day to give you the most pertinent information, etc. Feel free to sign up for that. Link is in the description, and I'll check you in the next video.